The Burlington County Chamber of Commerce presents its Economic Outlook panel, recorded February 22, 2011. Now let's go to the lectern where John Pagenkoff, chair of the Chamber's Economic Development Committee, is about to introduce today's program.
These forums happen quarterly. As many of you know, I do see a lot of familiar faces, but we do have an Economic Development Committee that meets most months. It's the fourth Tuesday of the month. Our next meeting is on March 22nd. Feel free to come out and join us and see what's happening in the county level from private sectors as well as public sectors, planning events such as this, and other things on the local level. If you want to get an email with the agenda for those after the forum, give me your business card. I'll make sure you're on the loop to get an invitation for those Economic Development Committee meetings. Our four speakers today, we've got Kevin Kutcher. Mr. Kutcher is the President and Chief Executive Officer of Liberty Bell Bank, serving in that capacity since the bank's inception in 2003. A career banker, more than 30 years in various management and executive positions in both large and small banks. His last 20 years have been in executive positions within community banks throughout southern New Jersey. Mr. Kutcher is a trustee from the Virtual Health Foundation and served as president of the South Jersey Bankers Association and is presently active in a variety of civic and charitable endeavors that include the current role as board chairman of the United Way of Burlington County. George Sowa is from Brandywine Trust. He's been there since 1998 and is responsible for overseeing operations and development of Brandywine's nearly 6 million square feet of office space in the New Jersey and Delaware regions. During his career, he's completed over $750 million worth of acquisitions, development, leasing, and financing. Steve Poniatowcz is Vice President of South Jersey Energy Solutions. He joined South Jersey Industries in 2000 and has quickly risen through the company and its subsidiaries to be an expert in the area of business development and operations. He's got a bachelor's degree in mechanical engineering. Not many people admit to that, but that's okay. From Lehigh, and an MBA from Villanova. He's a member of the American Society of Mechanical Engineers and the Project Management Institute, and has more than 28 years of professional experience in the energy industry. He's currently president of NIOP, New Jersey Chapter, National Association of Industrial and Office Properties. Also serves on the board of several organizations, including the National Board of NIOP, the Chamber of Commerce Southern New Jersey, Evergreens, and is past president of the Business Committed to Burlington County and a Cornell grad. Lastly, we have Chip Miller, a local fellow, Rancocas Valley alum, and a Rutgers grad. Started working in his father's dealership in the cleanup department. So Chip, that was what, you were like a 60s detailer? All right. He's now president of the Miller Transportation Group, which includes Miller Ford and Lincoln Sales, Miller Subaru Corporation, Miller Auto and Truck Leasing Corporations. Chip was recently recognized by Time Magazine as a 2011 Dealer of the Year, a prestigious award for one of the nation's most successful new car dealers that have demonstrated a long-standing commitment to community service. He's a Mount Holly Rotarian, a Rotary International Paul Harris Fellow, past chair of the Mount Holly Municipal Utility Authority. Was I supposed to say that or not? You guys okay? All right. And past president of the Rancocas Valley Board of Education, and the list goes on and on. Please join us as we hear our speakers, and after the presentation, we'll hold questions for the end. So if we could see how time goes, and we'll begin holding questions. Kevin? Thank you.
Now I see why the minister always says, come on up front. I'm usually the one in the back too, so thank you. We appreciate the opportunity to be here. Hopefully we can I'll share a little bit from a banking perspective of how we've seen some things, and I've had a couple of interesting conversations already this morning. 2010 for us in the banking industry, there's a little bit of difference in the banking industry. I think a lot of us learned a little bit about banks in the last few years, and there's a huge difference between the headline banks, those big bad Wall Street guys, and the banks that you know, the banks that you typically deal with. Very few of us have checking accounts at Lehman Brothers. So most of us have banks around here, TD, Cornerstone, Liberty Bell, Delanco. I mean, those are names you know. So in 2010 was a year of realizations for us of the trickle down of 2008 and 2009 at the national level. Now, we don't really call it trickle-down. We call it the Niagara Falls effect. I mean, we've just been inundated with change at our level for all of the ills that we had little to do with. So there's a huge difference between what the headlines and the media called banks and what most of us know as banks. So fortunately, most of us have had that education, and we benefit from it in that small way. The Wall Street types felt it first because they felt the ill effects of the garbage that they created. And truly, they created some garbage. I'm not here to kill Wall Street banks, but I would say to you that there's lots of ways that you can read about it and learn about that problem. And it really wasn't Wall Street. There's a lot of politicism in it as well. If you've got the opportunity, you like my slide? Cool. Christy asked me earlier, do you have some things that plug in? I said, no. She goes, well, good. It's not working really well. I said, for once, I'm prepared. So anyway, what happened is if you have a chance to read a book called The Big Short by Michael Lewis, it's a little bit cumbersome. It's a little bit challenging to read through, and he knows it because 3 times during the book he stops to congratulate you for getting that far. But the point of it is, if you just stick with it, you'll realize that there was basically a handful, and literally a handful of folks that you could narrow down what we're in today from. And it all has to do with residential lending and how we packaged bonds and things like that. But that's not why we're here, but we're all recovering from it. And that's what 2010 was largely about. We're still assessing loan portfolios. We're dealing with the trickle-down effect at the economic level of where we stand today to find out which of our borrowers has been affected enough that they can't repay us at our local regional level, whether it's us or the banks that surround us. We're adjusting our cost to compensate just like everyone else has. I mean, there's probably more than a few business owners in the room that realized, I didn't need all those employees. I might have to do a little bit more work myself for a little while. I'm not enjoying that. And then it's a right sizing, and it's not necessarily a bad thing. They do call them cycles for a reason, and this is the part of the cycle that we don't like, but it is a cycle. So we'll get through it. So what we're dealing with is a lot of overreaction from regulators and regulation. In 2011, what to expect? Well, we're going to complete those assessments and try to work with those who we can work with, salvage where we can, and take our lumps and bruises as an industry where we have to. You won't see a lot of that, though, at the local level, because most of us are not entangled in those issues. We are going to recover from that ongoing overreaction and overregulation. The Dodd-Frank legislation that you may or may not have heard a little something about. Chris Bishop asked me about it earlier this morning. 848 pages long, of which there are no rules written yet for how to enforce it. The legislation alone is 848 pages. So they're going to figure out how to enforce those rules, and that just trickles down to regulation, which does change our cost structure as an industry. So we have to share that in some fashion. I had a moment yesterday to pull off a couple of reactions so that you don't think they're just mine to Dodd-Frank. This is off the internet. There's an old Italian proverb, you don't where you eat. Wall Street banks did exactly that. Mortgage-based assets are a huge and critical part of the financial system. The big banks worked tirelessly to produce extremely poor quality assets by abandoning all underwriting standards for mortgages. You don't typically lend 100% on an asset. You don't typically lend to people who don't have to verify income. But we did that. So we'll talk a little bit about that. Another reaction. No question the larger banks need supervision, and boy, did they ever screw up. My problem is that with the new regulators is, what is the difference between them and the old regulators? Regulators were all over Fannie Mae and Freddie Mac, but it didn't do any good. So, to their credit, if there is any credit to be given, they've got a lot to learn too. So they're learning at the same time. The worst thing in the world that you can have to deal with, and some of you are in regulated industries in other ways, when you get your audits, the worst one you want is the rookie, because he's reading the book. And in some cases, the book that hasn't even been completely written yet. The good news is the FDIC is so overwhelmed that they're bringing back experienced former regulators to come in. Let us tell you what that's like. We get regulated about every 12 to 18 months, depending on where we are in the cycle. We're a state bank. And the FDIC also regulates us. So we're in our cycle right now, and every third cycle they do it together. We have 48 people that work in our bank, 21 of them in one building. We have 16 regulators and auditors in the building today. Hello? I mean, how much can they look at, and how much damage can our little bank and other little banks like us do to the economy when WAMU, what was it, 69 billion? They're still writing down $30 billion worth of assets there. How does our region compare nationally was one of the questions. If I had statistics, you could see them, but I'll read them and you'll get the picture in a hurry. Just from a banking perspective, from 2003 to 2007, of 9,000, 10,000 banks, however you want to count them, there were 12 that failed in 5 years. 12. In 2008, there were 25. 5 from California, 2 from Florida, 4 from Georgia, 1 from Illinois, none in this region. 48% of the 25 came from those 4 states. In 2009, as we got deeper into the issue, 140 banks were declared as failures. 16 from California, 14 from Florida, 25 from Georgia, 21 from Illinois, 76, 55% of the 146 from the same 4 states. 2010, 157, 140 grew to 157, all up from 12 from a 5-year period 3 years ago. Reading them across, 12, 29, 21, 16, 78, 50% from 4 states. It starts to get a little redundant. Oh yeah, there were 6 in all of the 157 that came from New York, New Jersey, Pennsylvania, and Delaware. In 2011, so far, there are 22 named failures, 55%, 12 of them. You want to guess where they came from? 0 from this area. We were talking earlier. One of the reasons, it's good to be in this region. Now, there's some neighbors of ours who might not be saying that at the moment, but generally speaking, Beverly and I were having that discussion, you know, this is not a bad region to be in, and one of the reasons that we think that we are not as bad off as some of the other regions are is because we struggled in prior cycles, and we've overexpanded before. We just don't have enough room for overexpansion anymore. So we don't have large developments of empty homes and large supporting shopping centers waiting for those homes to be filled. We just don't have the room for that. We have some of it. We're not without it at all, but we have far less of it. So we're not as significantly as affected as they are in places like California, Florida. I didn't mention Arizona. I left them out. They were the 5th largest frequency of failures. So one of the things I could tell you is banks in our region are struggling a bit, but not nearly as much. Obviously, struggling is clearly defined as failure, but it's not happening very much around here. On average, though, in New Jersey, in 2009, banks were barely, and I mean barely, profitable. That's all banks chartered in New Jersey. In 2010, we've come out of that a bit. We're not coming out of it strongly. We've adjusted a lot of our margins and some of our costs. The big thing for us is going to be dealing with regulation and the changes that have come about from the Wall Street era, if we can use that. That pendulum swings fast and hard, and it takes a long time. It never seems to land in the middle for long. So we'll see what happens with it. But we've not had the overdevelopment. So we've not had the overrun up of real estate values, and therefore not necessarily the trough. We've had some of it. We're not without it. But by and large, the banks in our region and the kind of banks that are at the Main Street level, who weren't buying bonds supporting poor mortgages, we're making prudent loans. Now, one of the things that you hear a lot about is banks are not lending. Well, banks are lending. It was Beverly again, we were talking earlier, and we're going to hear some more from Brandywine. Their business is renting out space. It doesn't do them any good to not rent out space. It doesn't do us any good not to rent out money. We're in the business of lending. We need to lend. But if there are no genuine borrowers, we're not going to lend. And there's a lot of less lending demand right now. If you think about it, most of us in the room are saving more and paying down debt. Well, if we save more and pay down debt, we spend less elsewhere. So the retailer is not going to finance inventory buildup that they can't sell. The builders in the room aren't going to finance labor and equipment and land to build homes and shopping centers that they can't in turn sell and rent out. So until that corrects itself, we're not lending. We want to lend. It's just the qualifications. And we as prudent lenders have always looked for down payment. Wall Street, hello, down payment. We've always looked for capacity to repay. But if there are no sales and there's high vacancy, there's a little less capacity to repay. So some of us, we're not lending. Our standards are no different today than they were 5 years ago. It's just that the headlines, and someone was talking to me about headlines and media. Chris, help us out. You always are. Write the good things about what's going on in the economy. You heard about it earlier from Mr. Donnelly. Things are a little bit better, and it's going to take a little while. We are in a cycle. So overall, for us, it is a little bit of rebuilding. We're glad to be in a region like this that's a lot more diverse, and it's not significantly dependent on any one employer or industry base. That's very helpful. And fortunately, we took our lumps in earlier developments when we sprawled a little bit more than we should have. We're always asked for rate projections as bankers, and we typically shy away from making them, so I will. No, rates, we see them as relatively stable. We're not going to see a significant difference. To put some of that, though, in perspective, the prime rate 5 years ago was, what, about nearly 8% or so? It's been 3%, and it dropped from 7% in the beginning of 2008 to 3.25% by the end of 2008 in 7 moves in 12 months, and it's been at 3.25 cents. There's not a lot of margin, hence that 2009 where banks aren't making a lot of money. And yes, your CD rates are earning less, but we're in a very, very simple business. We rent money in from you in things we call deposits, and we rent it out in things we call loans, and there should be enough left to pay our overhead and the police. And that's a little difficult to do when rates are in the current environment that they're in. We're going to see them flat for a little while longer, nothing material happening, at least in the mid and long term. You might see a little bit of short-term rates by the end of this year, tick up a little bit, but you know, who knows? But we'll have to wait and see. Thank you.
Liberty Bell is lending. They're financing a small residential project I'm working on. Thank you very much. George, you're going to talk to us about the commercial real estate. What's going on? Thank you.
Thank you, and I'm honored to say that we actually had one of those banks that did fail here in New Jersey, so I feel quite honored to actually have one. But and anyway, well, thanks for having me here this morning. And I was asked to speak about the commercial real estate industry, and yeah, I can rattle off a number of statistics on the industry, where we are, where we aren't. But much like a balance sheet, it really is a snapshot in time. And so I always found it to be very helpful to look at it on a comparative basis, so you can get a better understanding of trend lines and where we are, where we think we're going, and trends for the future. So if you look back 10 years ago, unemployment in New Jersey, we're about 4%. We had a 10% vacancy. We had strong absorption, 95,000 1999 and 2000. And relative state of equilibrium. In that landlords and tenants, neither side really had much leverage when we're negotiating with one another. Flash forward, year-end 2010, actually New Jersey has an unemployment rate of over 9%. And granted, it is coming down, but still we're over 9%. Very few jobs being created. Office vacancies about 18%. And absorption has been negative for 12 consecutive quarters in 13 of the last 15 quarters. So tenants absolutely have significant leverage over the landlords these days. Unfortunately, the southern New Jersey market really has been hit with a number of things where we were very heavy on the finance and mortgage-related companies. We've also had the defense sector that traditionally has been very stable and actually was growing in some of the better years, where they were absorbing in one company alone about 500,000 square feet net absorption just unto themselves. We're not seeing that right now. So that is a backdrop. Why am I feeling more optimistic now than I have at any point in the last 3 years? Job creation is a critical driver in the vitality of the office market. When companies are hiring, they create demand for office space. While it's still a little too early to find any evidence that companies are hiring of any consequence, we do see the corporate confidence coming back. That confidence really manifests itself in a number of ways, where if you look at the length of lease term, for example, if they're starting to expand, and we've had actually a couple of companies actually expand significantly, and sign leases of 10 and 15-year terms. And in the past, what we were seeing is that companies would end up renewing, assuming they need the space at all, or they come to us in 6 months, 1-year increments, and say, can we just stay? We don't know what the future holds, and we just can't commit long term. And so at that point in time, they were saying, can we just do 6 months, a year type extensions, and just go very short-term increments afterwards. Again, we're not seeing that these days. Companies are committing for longer periods of time. Unlike 1999-2000, where you had some of the tech booms, where companies were overconfident and actually leasing more space than they actually needed, it seemed like companies were going the other way, where they're trying to contract and actually extract any efficiencies that they can. And unfortunately, anybody had an expiration in 2008, 2009. It seemed like a lot of those companies were trying to just close their doors, lay people off. It was a very, very tough time. But again, we're seeing that turn again. The confidence, again, coming back. And further evidence of that confidence is the Philadelphia Federal Reserve Index of Regional Factory Activity rose to the second highest level in the last 10 years, second only to the peak that they saw in 2004. So while corporate confidence may be coming back, private sector jobs that were eliminated during 2008-2009 across the country, and including New Jersey, have not yet returned. At this point, it's best illustrated. I have a couple of slides. Hopefully, we'll be able to get those up. Okay, great. Thank you, Chrissy. There's not a whole lot of slides, but I thought some of these are very, very telling in terms of where things are. So this slide actually shows the real GDP, the gross domestic product. Actually, between third quarter of 2008, the far left red bar, actually we troughed in fourth quarter of 2008. And the green line, if you hit it again, Chrissy, possibly. Yeah, the green line, which now is up on the screen, actually shows a trend line where we actually experienced some very strong growth there at fourth quarter of 2009, especially relative to the trough that we'd experienced previously. So again, if you kind of look at that, that gives you a good context of the GDP from the third quarter of 2008, fourth quarter of 2009. Next slide, please. This slide actually shows the private sector employment change between 2008 2009. Where if you look 2008, 12-month loss of jobs, 3.8 million. Again, these are national statistics. 2009, 12-month loss, 4.7 million jobs. So total between 2008 2009 jobs nationally, about 8.5 million jobs. Staggering numbers. Again, across the country, staggering numbers. I heard one of the politicians, not exactly accurate, but he said there's more people unemployed in the United States than there are in all of Canada as citizens. But it wasn't exactly accurate. But when you look, it's still 8.5 million people just lost their jobs during that point in time. Next slide, please. Now this shows 2010. Actually, we had strong employment growth in 2010, especially relative to 2008-2009 period, but still this gain in total about 1.3 million jobs. If you put that against the 8.5 million jobs or so that were lost in the 2 previous years. Next slide, please, Chrissy. Maybe hit it again. Okay, let's see. Yeah, so the blue is the GDP. This shows 3 years ago we got back to the same level of GDP. The red line actually shows employment. So if you look, that gap represents 7 million fewer jobs, yet we're still back to the GDP that we were 3 years ago. So it's staggering in terms of the production that companies are able to get out of their employees or through technology, despite 7 million fewer people working across the country. So again, it's a staggering statistic when you think that we're achieving the same GDP that we were 3 years ago with 7 million fewer people working today. Again, across the country. Next slide, please. Now, this slide actually shows New Jersey, so we certainly weren't isolated from what was happening across the country. 2008 through December 2010, we certainly were much more lumpy, if you will, than the national. Where going into 2010, we certainly saw some ups and some downs. Where we did have some growth, but offset with a couple of other months that certainly mitigated some of that growth. So again, if you look at jobs lost 2008 to 2010, January 2010, about 245,000 jobs in New Jersey. Then February of 2010 through December 2010, 8,200 jobs were created. So again, we're still off dramatically within New Jersey. And next slide, please, Christy. And this slide, and this is the last slide that I have, the composition of the employment losses within New Jersey, rather dramatic changes if you look at the previous recessions that we went through. March 1989 through May 1992 recession, 265,000 jobs were lost. Almost 88% of those were in manufacturing construction. Not great news if you're in manufacturing construction, but 88% of those, with about 12% being services. The December 2000, March 2003 recession, 85,000 jobs were lost, about 76%. Again, a very, very high percentage for manufacturing construction, about 24% from the services. This recession, the January 2008 through January 2010, 245,000 jobs were lost. Only 38% of those were in manufacturing construction. So again, the composition this time was much different than the two previous recessions that we had, with 62% of those jobs lost being from the services side. Again, selfishly from the office perspective, the services side is where we have the tenant bases within our office buildings. And again, it's, this time it was much different than the two previous recessions that we had. While I assure you this isn't a political endorsement or commercial of any kind, I am encouraged with a focus on retaining and attracting businesses by the current administration on both sides of the aisle, the Democrats and Republicans. And hopefully, we'll get some of these companies in from Illinois or any other place that we're starting to spend some time out there. But rather interesting, in 1913, New Jersey was the #1 state in the entire nation for business and corporation. At that point in time, we were literally the #1 in the entire country. Somewhere along the line, we lost our #1 status, and we also lost our focus in terms of trying to attract companies and businesses to the state. So it's imperative that we end up trying to get back to that, to create clean rateables and the taxes that are associated with it, to try to minimize the taxes for the people that actually live and work within the communities and our buildings. But there is some good news in the office market. Vacancy rates, while still higher than we'd like to see them, have stabilized and actually started to come down in some submarkets. In addition, the level of negative absorption, again, while still negative, on a year-over-year basis, have actually been improving as well. And job losses have also been declining, and have actually started to see some job growth in a couple of key industries and some early positive signs. And while the office market appears headed to recovery, the industrial market appears already be in the early stages of recovery, particularly in some markets. The industrial market's been experiencing strong absorption the last few quarters, and vacancy rates continue to decline to today's 8.2% rate within the region. This is down from 9.1% from the beginning of 2010. Commercial real estate's an absolute demand-derived business in that we cannot create demand, but rather we simply supply inventory with the hope that the companies will come to our buildings. The disruption in the real estate market and the capital markets really has greatly reduced the amount of speculative construction that's out there in the marketplace today. To illustrate this fact, new office development starts traditionally have averaged about 2.25% of the entire market that's out there. In the last the last 40 years, we've had peaks of 4.5% of new inventory just for the office side coming in the mid-1980s, and we had a 3.5% of new office space coming online in the late 1990s. In contrast, the office starts today are less than half of 1%. This is the lowest that we've ever seen in the last 40 years. So again, there's just no new inventory being built today. Again, not great news if you're in construction, but certainly it's from an office perspective, the existing space is going to be absorbed rather than having new space being created. The same is even more dramatic in the industrial side. Over the last 40 years, the annual amount of industrial starts have averaged about 3% and actually peaked at 7% in 2000. Put this in perspective, the industrial inventory averaged about 150 million square feet of starts each year over the last 40 years. And in 2000, about 350 million square feet across the country was added to the inventory just on the industrial side. 2010 industrial starts across the country were 0.4%, so again less than 1/2 of 1%, about 45 million square feet being created across the country. And this again is the lowest level in 40 years. And even more dramatically within New Jersey, there's only about 8,000 square feet of new spec construction happening within the state. And due to rounding, it literally becomes 0% of new construction coming online. relative to the inventory. But that said, quality tenants still understand they need to have well-maintained buildings, well-operated, stable ownership, and certainly we're seeing a flight to quality. So there are some good things happening within the market. Again, it may not necessarily be great for the market in total, just because companies may be consolidating from 2 buildings into 1. But again, if you're the prevailing landlord, this could be a very good thing for you, and ultimately the other buildings will get backfilled. But it's always been a very competitive business, and certainly it's more competitive now than it's been in the past. But again, it's one that if you kind of look at the business in terms of where things are, we are starting to see some positive signs. And we certainly see this not as a time to panic, but really look for good opportunities that might be out there, because there's certainly, with a well-capitalized company, there's opportunities out there, and now it's certainly not time to panic, but there are some great opportunities to try to land some of the good companies that are out there, much like the banking business, where if we have good companies coming in, paying the rent, this is a good thing for us, and ultimately things will turn around again. But we are starting to see some positive signs of that happening. So thank you.
George, thank you for that positive uptick, although gradual. We'll take that. I have been working with a project trying to expand in New Jersey, and earlier this month, Lieutenant Governor gave her cell phone number to this user and said, listen, any deal you get to move out of the state, call me anytime, 24/7. I'll match, beat the deal. I mean, listen, they're working hard. It's good to see that things are moving well ahead with Brandywine as well. Steve, a lot happening in energy. Come and share with us what's going on. Thank you.
Good morning, everyone. First, I want to thank the Chamber of Commerce for the opportunity to come out and talk with everyone today. Definitely appreciate that opportunity. And I apologize because I must have missed the message when I was told to come to Burlington County College to give an update on energy. I thought it was a whole semester course, so I prepared plenty of notes and opportunities here. But then I was told later on this morning to cut it down to 7 to 10 minutes. So there's an awful lot to cover in the world of energy. It is a very fascinating area to be in right now. I've been in the business for 27 years, and when I started out, nuclear generation was going to be the solution of all mankind. Now it's going to be solar. In 27 years later, fantastic place. It's really a privilege here to be in Burlington County. We have maintained an office here in Burlington County in Mount Laurel on Route 73. And we also lease and operate the landfill gas energy plant at the Burlington County landfill up in Columbus here. And we've been doing that since the end of 2006. So we have a presence here in Burlington County. We have a stake in Burlington County. We're very interested in Burlington County. We think it's a great place to do business. And I want to talk some more about some of the things of energy, some of the things about energy itself, electrical capacity. I'm going to talk a little bit about renewables, natural gas. I'm going to try and wrap it all together to try and paint a picture of what it looks like going forward, particularly relative to Burlington County here.
I'm sorry, I need
George did rabbits, I'll try and do. So electricity consumption in the state of New Jersey in 2005 versus basically where we are now. In 2005, we made 81.9 million kilowatt hours. Consumed 81.9 kilowatt hours across the state of New Jersey. Total consumption recently is about 82 million kilowatt hours, roughly about 2% you've come up. Not very much. It's been very, very small, very flat. How are 82 million kilowatt hours consumed? As you can see, the majority of it is in commercial business. Folks like yourselves use the majority of electrical energy within the state of New Jersey. The rest, set number 2 is residential. 37% is residential. We can thank the video game market for that nice increase over time, and also 14% for industrial. Unfortunately, that's gone down in the state of New Jersey over time. The industrial base of New Jersey has decreased. Chrissy, next, please. What about the cost? Obviously, everyone seems to have an opinion about the cost of electricity. Everyone gets the bill from their local electric utility, whether it be Atlantic City Electric, Jersey Central Power Light, and of course Public Service here in Burlington County. Residentially, you've been paying about 15 cents per kilowatt hour, and that has been relatively flat since 2008. Similarly, with commercial, about a little bit less, 12 cents a kilowatt hour, and industrial, about 10 to 11 cents per kilowatt hour. The reason for the lower prices is basically industrial and commercial usages are much more predictable, they're much more load-based, whereas residential is much more weather-based. You know, the hot weather comes in, everyone turns on the air conditioner, and hot weather goes away, everybody turns off their air conditioner. And basically that's why you pay a little bit of a premium for that. Also, just a matter of quantity and economies of scale and service. Tracy, next please. Another big driver in the state, and something that's caught the eye of the governor recently, is what they call capacity pricing. And basically what capacity pricing is that for every generator that puts electrical energy into the PJM grid, which is the Pennsylvania, New Jersey, Maryland grid that feeds, obviously, New Jersey, they get paid a rate based on the size of their unit, and they get paid every day that money whether they operate or not. Basically, it's a capacity. They're paid to be there just to be ready to go. And that price is determined on an auction that's set 3 years into the future. So in essence, for example, landfill gas energy plant, which is in Burlington County here, is 7 megawatts, and I participate, our plant staff participates in an auction every year, 3 years out, to figure out what they're going to get paid capacity from June of 2013 through May of 2014. And that price, auction price is just clear, that's to be $243, okay? But the interesting thing here is, if you look earlier over time, you realize that your cost of capacity has gone down significantly, okay? This price signal tells people that they're not going to come in to build generation because there's really no value in that, okay? This is kind of their debt service. This is how generators pay their debt because they got to pay the banks whether they run or not, okay? This year it goes up, but the big interesting thing is it goes up and down. So if I want to build generation in New Jersey and I'm going to run to the bank, I'm going to run to Kevin and say, Kevin, I'm going to build a capacity plant. It's going to be 100 megawatts. He's going to say, fine, how much can you afford to pay in your debt? And he's going to look at this capacity payment. And guess what? It goes like this. He's going to devaluate that. He's going to say, no, I'm not going to loan you money. No new generation, no new large electrical generation is built in New Jersey for many years. It's been small, it's been renewable, it's been manageable. And this has become a problem. Next slide, please. Because if you look, the 82 million kilowatt hours of generation that we in New Jersey use, only 62 million come from within state. The other 20 million are imported, okay? And of that 62 million, this is roughly the fuel mix of that generation. 32 million is basically nuclear. That's your Oyster Creek, your Salem Unit 1, Salem Unit 2, and Hope Creek. That's 32 million kilowatt hours generated. Roughly about half of the state, just over half. The next biggest one is natural gas. Okay, natural gas, although it burns cleaner than coal, traditionally has been more expensive, and that usually sets the price equation for generation within this region, particularly this region. Coal is 10 million kilowatt hours within the state. There's still a few plants around, Burlington City, Logan, and I think Mercer's coal plant. Renewable sources are 1 million kilowatt hours, okay? So relative to the 82 million kilowatt hours that you see in your electric bills, we're actually, the renewables, your wind, solar, landfill gas is actually a very small percentage. Our combined landfill gas generation plants, and we have 5 of them within the state of New Jersey, made 109,000, about 10% of that 1 million megawatt hours last year. So we're a bit of a good player in the renewable energy sector. We're also heavily into solar now as well. Petroleum, your oil-based units, is obviously the lowest. Why? Price. Oil's gotten very expensive. It's not a very popular fuel with a DEP. DEP regulates it very hard, particularly in electrical generation, and they've been trying to push that out. So clearly that's been taking kind of the last position within generation within the state of New Jersey. Next, please. We talked a little bit about renewable energy and how do you motivate people to build and develop renewable energy. And there's two ways. Well, one way is what they call Class 1 renewable energy credits. And these are renewable energy credits that are traded separately when you use landfill gas, wind, geothermal, and biomass to develop your energy. So, for example, our landfill gas plant up the road here creates renewable energy credits. And those credit markets are basically sold on an open market to electrical suppliers that have to provide you electric. So you have PSE&G, Atlantic City Electric. If you go maybe a third-party supplier in your business, like a Hess or South Jersey Energy or a Pepco, they also have to buy those renewable energy credits, okay? Right now, the current price per megawatt hour is about $1.50. When we developed our first landfill gas plant in Atlantic County in 2009, we projected that the price would be $7. The first set of trades we got was a 5-year deal from J.P. Morgan at $9. We were happy as all get out, okay? Those deals just ended, and now we're getting $1.50. In the meantime, they went as high as $17. Who's the next slide? So you can see, back in 2008, they were sitting at $17. It was a great time to be in the renewable energy business. We wanted to build every landfill gas plant in town. This is the price that's come over time. Obviously, there's a forward market for this, very low. After 2014, right now you're paying about $3.50, $2.50. So what happens is, it's a bit of supply and demand. A lot of the renewable energy credit markets are actually dictated by the Board of Public Utilities that say they have to have so much in the mix. And when there's none online, there's a very high value, supply and demand. Everyone rushes in, starts rebuilding renewables. Your usage goes flat, and the price of the REC comes way down. The other big renewable is what they call solar electricity, and I've had several conversations in the room this morning about solar electric. Solar electric is very, very expensive from the cost to construct. It is more expensive than a gas plant. It's more expensive than a coal plant on a cost per kilowatt basis. Okay? It's comparable almost to a nuclear plant. Now, no one's built a nuclear plant in a long time, so the benchmark there is very, very difficult to verify. But right now, the current price per megawatt hour of an SREC in 2011 is $650, which is a very lucrative amount. And what the Board of Public Utilities tells the retail suppliers is that if you do not provide a SREC, you have to provide what they call an ACP or an alternative compliance payment. And right now in 2011, I think that alternative compliance payment is about $710. So clearly there's a lot of headroom for these SREC prices to be bid up. It also takes a little bit of time to get these plants online, so right now there's a bit of a shortage. But if you go look forward, Chrissy, you'll see over time, the top line is the solar compliance payments, and that's dictated by the Board of Public Utilities, okay? But this is the forward market, and the price is going down. And it's going down because, just like with the renewables, everyone's running out to build renewable solar plants, okay? Which is fantastic because New Jersey's a garden state, and they have lots of wide open land, okay? And people are finding that you can actually make more money putting a solar panel on your farm than trying to grow something on your farm. And you see a lot of that. You see a lot of that in Cumberland County, Salem County, and we're starting to see a lot of it up here in Burlington County as well. It's kind of an interesting mixed bag of news. Because of Burlington County and its very good position relative to the electric grid, relative to North Jersey and relative to Philadelphia, you have very good electrical infrastructure within this county. And because of that, a lot of solar developers can easily interconnect your system here. If you go further south in the state, down toward the Peninsula area, Cape May, Salem, Cumberland County, things down that way, Atlantic City Electric never quite had to develop that type of infrastructure. You can get a nice, good infrastructure around Atlantic City and some in Philadelphia, but everything down there below 55, when you go down the shore down that way, it's pretty rural. Lots of open land, but the infrastructure, the wires can't handle that generation. So it costs a lot more to put solar in at that part of the state than it does in Burlington County. Clearly, there might be a challenge. There's environmental challenges as well, but I'm sure everyone's been aware of that over time. Kristen? All right, let's talk a little bit about natural gas, another key piece of energy here. Total natural gas consumption in 2004 averaged about 600 million cubic feet per year, okay? And that consumption is basically expected to stay consistent in the near term. It'll go up and down with weather, but basically what we're seeing is a relatively flat consumption within the state of New Jersey. What we've seen a lot of in the state of New Jersey, and you're going to see a lot in the Northeast, is the price of natural gas is going down, okay? In 2007, it was $8 decatherm. In 2009, it was $9.11 decatherm. When the economy slows down and people are making less product and people are consuming less electricity, it's supply demand again. The price of your price setting fuel will go down. It's going to be $6.81, $5.92. But even now, with the cold winter, it's relatively, against history, relatively low as far as the cost of fuel. The other thing that's driving this is supply demand going forward. Next slide, please. They've discovered a geological formation in the state of Pennsylvania called the Marcellus Shale. Now, I don't know if anyone's heard about this Marcellus Shale, but depending on which geological report and what college they go to, they say you either have somewhere between 50 and 500 trillion cubic feet of recoverable reserves within the Marcellus Shale. This is not the first shale formation to be recovered in the United States. They've done several down in Texas, Barnett Shale being probably one of the biggest ones. So the technology does exist to get natural gas out. This becomes a serious, serious game changer. Because back in the 70s, everyone swore they were going to run out of natural gas by the 90s. In the late 80s, they deregulated natural gas. Then it kind of became like the wild, wild west with natural gas pricing. But they really didn't find that many new formations, that much new sources. Now they're finding, because of this technology, new ways to recover natural gas. Okay, so this is almost like the oil run. It's like a gold rush. If you go out to western Pennsylvania, you see a lot of the big Texas companies are setting up regional headquarters out in that western part, Pittsburgh area there. And they've been doing drilling out there for several years. Our company has taken some passive interest in some of those drilling operations. Okay, plenty of gas there. The one problem is the infrastructure to get it out of the ground and into the transportation pipelines to get it over here doesn't exist yet. But it is coming. There's a lot of interest in developing that type of stuff. There's ongoing. I think we covered most of that. Next slide, please. So you have this electric capacity market, okay, and I don't know if anyone heard about the LS Power bill where they're basically going to try and project forward and lock up capacity so that people can build generation here in New Jersey. But there's some influencers that are going to really help to change the energy price, the energy marketplace going forward. Things that are going to probably push energy costs up. More renewables. Renewables are a little bit more expensive than traditional generation to develop. They can be a little bit more difficult to interconnect as well. Okay? They also get renewable energy credits, which gets paid for by the consumer as well. Retirement of older coal-fired generation. Now that we have a lot more natural gas available to us, now that the DEP is putting a lot more pressure on older generation, now that the EPA by law can regulate greenhouse gas, it is fairly expected that a lot of older generation, coal-fired generation that was built in the 60s, the early 70s, and the 50s are probably going to shut down. Okay? If you pick up your paper, you look at the Eddystone coal units over by Philadelphia, they were built in the early 60s, they're shutting down. We expect that to continue throughout the United States. Increased federal and state regulations, the EPA, as I mentioned before, is going to help push some of these things out. Things that could reduce the energy costs. Again, vast amounts of natural gas getting into the system. And natural gas burns cleaner in electrical generation, thereby reduces the capital costs required. It reduces the post-combustion environmental treatment. Also, energy efficiency. There is a huge push, and there's been a big push over time, for people to become more efficient. Okay, we hear about LEED, acronyms such as LEED and LEED buildings and things of that nature. You are starting to see a lot of demand-side management programs, particularly as they're used to be economic drivers and decision-making, take effect and lower the cost of the peak electricity especially. So, if you have more natural gas as your generation base, one of the things that we believe is going to happen going forward is that since there's a lot of natural gas transmission and distribution pipe in the ground, and there's a lot of people really don't like the idea of having a lot of transmission wires placed overhead because of their environmental impact, we see an increase in what they call distributed generation. Small generators located close to the source, okay? And it's not unlike computers. I don't know if people remember big mainframe computers. When I was in school, you actually had to punch a car key to give it to a central operator, and he ran your program. Now everything's distributed, right? Everybody has one of, everybody has one of these, right? Your distributed computer, you walk around. Same thing with, telephones and things of that nature. We see energy kind of going the same way, and we see natural gas kind of being one of the key drivers of doing that. Small generation, close to the source, integrated to make more of a better grid and a better network. Next, please. You also see a big uptick in combined heat and power, which is clearly a much more energy efficient process. And we've developed several of these things, both in the state and up around the Mid-Atlantic area as well. Some final thoughts. Our company, South Jersey Industries, is well positioned to do this going forward, and look forward to it. Natural gas will continue to be the primary fuel of choice over coal-fired generation, also in support of distributed generation. Renewables, so long as there's government support there, we believe that renewables will continue to maintain and be part of the portfolio of energy going forward. And also, in the infrastructure and energy efficiency will continue to help New Jersey's sustainable energy future. And one last plug, the New Jersey Master Plan, if you're not familiar with it, I know they're just revising it and putting it out there. It has a lot of good ideas still in it. And I think New Jersey really needs to be commended because it's one of the few things that we work with that has thought enough about to put some resources into this and think about what their future is going to look like going forward. Thank you very much for your time.
Afterwards, make sure you see Steve for your certificate in energy that we're going to get from today's class. Thanks. And Chris, I know you had this in mind with Chip. Millerford has a new solar facility coming into their Lumberton site, so it's a good transition. Chip, come on up and tell us about Millerford.
Okay, thank you, John. This last recession was a lot different for automobile dealers than any recession that we've been through in the past. In fact, for a lot of automobile dealers, they feel like they've been the victim for a change, not a position that we're usually in. The collapse of automobile sales in New Jersey was very significant for dealers and difficult for people to adjust to. From 2007 through 2008, sales fell 14%, and they fell another 16% in 2009. Overall, from the high point of sales in 2005, automobile sales in New Jersey fell by a third. So this on its own would have been a significant challenge for automobile dealers to adjust to, as they had to right-size their staffs and get their costs in line with the level of business that was out there. But the recession this time around impacted dealers differently. It wasn't that the whole market dropped and there were a few people buying luxury cars or Fords or Chevrolets. But this time around, it depended on which manufacturer it was that you represented. With the bankruptcy of General Motors and Chrysler and GMAC, this had a significant impact on the dealer landscape. The manufacturers took advantage, with the help of the government's car czar, to try to right-size, they called it, their dealer base, and terminated a great many dealerships. This wasn't very well received, and Congress passed a law that required that General Motors and Chrysler go back, review how they had terminated their dealers, and determine whether some of these dealers were economically viable and in the interest of General Motors. This has been a slow process. A lot of dealers couldn't wait for this process to work through. General Motors worked, I'm going to say, fairly well with the dealers and has actually reinstituted a lot of dealerships. Chrysler, on the other hand, well, first I should also say General Motors was a little bit more generous in the termination provisions that they had for dealers. And while what they were compensating dealers wasn't nearly what dealers should have been compensated, at least they were making an effort to compensate dealers something. Chrysler, on the other hand, gave dealers basically 31 days to close their businesses down and get out of business. And they've taken a much more hardball approach in negotiating which dealers should be allowed to come back in business. I guess this put a lot of dealerships in a difficult position. I understand there were some dealerships in North Jersey that were told you've got to be out of business basically in a month. They had union shops. There are state laws which require, I guess, if you're a certain size, I think if you eliminate over 50 positions, you've got to provide 60 days advance notice, or you've got some salary payments that you've got to make to individuals. So there were a lot of people that were put into very difficult positions, and a lot of people had their entire lifetime of financial savings just go down the drain. In addition to this, banks decided that doing business with people in the automobile industry probably may not be a good idea. So a lot of banks exited the business, not just banks that provided financing for people purchasing cars from us, but also some banks that were involved in providing dealers with floor plan lines, mortgages, working capital lines. So that became also an additional challenge for a lot of dealers to try to survive that landscape. The recovery started for most car dealers, I'm going to say, in 2010. New Jersey car sales in 2010 increased by about 13%. And I would say that most dealers probably were profitable last year. There's always a handful that wasn't, but every month for every dealer seemed like it was a dogfight. And you got to the end of the month and you looked at your financial results and you say, well, that wasn't as bad as I thought it was going to be. Okay, as we approach 2011, we expect this to be a better year. The forecast we have from New Jersey Auto Outlook, which is a forecast of car sales in New Jersey by a local economist in Philadelphia, sponsored by the New Jersey Auto Dealers Association, projects that car sales will increase about 9% this year, 7% in 2012, and 10% in 2013. Yet we think there's a substantial amount of headwind out there and uncertainty as we move on down the road. We're still all dealing, the same as you are, with the increase in health care insurance and what impact this health care bill is going to have on our businesses going forward. The government's deficits, government regulations, the regulations of the banks, we think affect car dealers. We found credit available, that's not a problem, and I agree that terms seem to be pretty much in line with what they were in the past. This is more in our leasing business I'm talking, but the banks, the conversation period is just extended. The banks want to understand a lot more about your business. They want to dive into more details than they've had in the past to make sure that they're comfortable with the loans that they're making. Also, you know, there are other regulations that impact us, whether they're the CAFE requirements that have been put in place or that are proposed, and potential for things like card check and the energy cap and trade bill. As we go forward, used car availability will be a problem for us in the next probably 4 or 5 years, because used cars are based on new cars that were sold over the last 4 or 5 years. So if there aren't cars that were leased, we won't have as many cars coming back in the next couple of years off of lease, which dealers buy, and a lot of our used car business anymore is late modeled and certified pre-owned cars. So that will have an impact. Also, our service departments are very important to us, and we live off of units in operation, and the units in operation have been dropping as new car sales have declined, and cars have gotten older, because basically car dealers, we service cars that, well, we do some older, but in the 6-7 year old and less range. So as that number gets smaller, and it takes a while as sales ramp back up for it to increase, we expect to have some impact on our service departments. We find that credit is available for our customers with good credit ratings. There are good interest rates out there for them to buy automobiles, and we're starting to see an interest by banks in some of our more credit challenged, lower credit scoring and subprime customers. We think, I don't think, New Jersey Auto Outlook thinks that there are some pluses in New Jersey for our future of our automobile business and probably the economy in general. There's record level of pent-up demand for automobiles, and the average age of cars is at its highest level ever, while the scrappage rate also excludes the rate of new car sales. On the minus side, household debt is we think is going to slow down the recovery, and also will the slow recovery in employment and income. This will subdue retail spending by consumers until they're able to get their debt and savings in line, which really means that we expect to have a longer and slower recovery, which maybe isn't necessarily a bad thing. As far as my business, we've been fortunate to be a Ford and Subaru dealers, and I'm glad that I can't stand here and tell you how Chrysler and GM work with their dealers. Ford, I don't know whether it was, we'll call it good management on Alan Lawley's part as opposed to good luck, but his plan when he took over the company and decided to restructure them had the foresight to arrange their financing ahead of time and get it locked in, and weren't dependent as General Motors and Chrysler were on funds being available. As everybody knows, Ford didn't have to go through the bankruptcy reorganization process. And that good news combined with improvements in product quality and good press has been a plus for our business. Not that we were immune to the downturn in business. We saw our sales drop about 12% from 2007 to 2008, but we were fortunate to acquire the Burlington Lincoln Mercury franchise in 2009 and move it to our location in Lumberton, which gave us an increase of 20 or 25% in sales in both our sales department and service department. And I imagine anybody that was working their way through a recession to get a 20% increase in sales in the middle of it would have done almost anything to get that. We upgraded our facilities in 2004 with a major expansion and facelift, but had to go through a reskinning of our buildings in 2010 and meet some other requirements for the Lincoln Mercury franchise. This is going to be a continuing challenge for all automobile dealers as the industry recovers and manufacturers are going out and requiring or trying to require them to upgrade their facilities, and some of them at substantial costs of $500,000, $1 million, and even more. Our challenges in the last year for 2010, even with our increased sales, was to control our costs, particularly our personnel costs, and to make sure that we were still getting our unfair share, if you would, of the hot inventory, which is always a challenge for the dealers. But what we have really been focused on in the last year is trying to figure out how we can improve our customers' experience at buying and selling cars and getting them serviced. So we've spent a great deal of time with our employees on training and certification programs, just reviewing, training, and implementing different sales processes in our showrooms and our service departments. This is something the dealers have to do on their own. Manufacturers are pretty good at training you on their product. They don't have a whole lot of interest in the process of how you sell and service vehicles. We've also had to increase our customer follow-up. So we have added some personnel in the last year to fill in some flat spots that we had from the recession. The area that is probably the greatest challenge is how do we handle marketing and advertising with more customers using the internet for research. As fewer consumers read newspapers, network TV is very expensive, cable TV is fragmented, and 70 to 80% of buyers use the internet for research and they're on Facebook. We're challenged with how we communicate with our customers. We continually have discussions in our weekly advertising meetings. My son wants to get rid of all newspaper advertising. He thinks I don't want to be on the internet, which isn't true. We do a substantial amount of both. But it is a challenge as we work our way through it. The way we address the internet is through a business development center where we have a manager and we have 3 employees that handle all of our internet leads, all of our incoming phone leads, and we also use them to recontact customers whose loans may be maturing, customers who are about to come out of a lease, or their different manufacturers will have different programs at different times. If you, I think we've got a bounty now on $1,000 on competitive lease customers. So if we can find a list of those people, they work at trying to make service appointments with those folks. It's overwhelming sometimes, the numbers you got. Last year, we handled over 5,200 inquiries to purchase a car over the internet. We sold some 600 of them. It was up, leads were up 38% and sales were up 44% over the previous year. Our business development center, through internet, phone, and this retail cycle management program, touches 56% of our sales in 2010, up from 46%. It is, as I said, it's kind of still uncharted waters as we try to decide how many websites we need. We probably are using 8 to 10 different lead providers. We spend a bunch of money every month on search engine marketing, so when you type in Chevrolet Blazer, our ad pops up in front of you. As in most advertising, we know probably 25 or 30% of it works, but we still haven't figured out which 25 or 30% that is. So I think you'll see the automobile business continue to improve. I think in New Jersey, the number of dealerships has dropped in the last 5 years from about 720 to about 512. And the dealers that are still in business today will continue in business. Okay.
Thank you, Chip. Our sponsor representative was a bit delayed due to the weather, so at this time I'd like to introduce Brett Wiltsey, an attorney with Dilworth Paxton, for just a few words. Brett?
Thank you. And I know we're way past time, so I promise to be very brief. A few words about Dilworth. We're better lawyers than we are at snow removal. I shoveled my driveway, but didn't turn on my car, which obviously led to me being late today, so I apologize. The Cherry Hill office of Dilworth, we work throughout New Jersey, and we focus on real estate, banking, and corporate work. I can tell you, since this is an economic outlook forum, that my practice for the last 3 or 4 years has been about 90% either working for banks, chasing delinquent debtors, or representing our corporate clients with delinquent loans and workouts. It's probably down to about 65, 70% now. A lot of our corporate clients are now looking to either give their employees that performed during the tough times equity in the company, or looking to expand and consolidate their practices. So we're throughout New Jersey. Our office is 15 lawyers, and our mothership in Philly has 100 lawyers. So we're there to help with anything you need, and I won't hold you up any longer than that. Okay, thanks.
And thank you. And without the support of firms like Dilworth, we wouldn't be able to provide these type of forums for you. At this time, I'm going to conclude the forum and ask our speakers if they would just stay around. So those of you who have questions can ask them on a one-on-one basis. We did run about 15 minutes over time due to the weather, and I know a lot of you want to get to work. So I did not make any shameless plugs for chamber events, just in the interest of time. So I'm going to ask you to please grab an event sheet on your way out the door. I will make one shameless plug. Chip Miller is our Voice of Business Award winner this year. That dinner will be on April 18th. We have a great lineup of winners this year, so please join us at that dinner. And keep in mind that dinner has sold out the last 3 years, so don't wait. So thank you and have a great day.
We hope you enjoyed this program from the Burlington County Chamber. For more information, visit bccoc.com or call 856-439-2520. We produce these programs in the studios of Professional Podcasts in Cherry Hill, New Jersey, on the web at professionalpodcasts.com. For everyone at the Burlington County Chamber of Commerce, this is Steve Lubeck, and thank you for joining us, and take good care.